Good afternoon. My name is Brian Huang, and I'm Director of Financial Services Strategy at Intralinks, and thank you for joining us today on today's webcast hosted by The Deal. The topic for today's discussion is how the current global environment's impacting M&A, which is a top-of-mind subject for everyone in the deal-making community. While the global economy continues on a steady path, potential policy changes could alter the M&A landscape. From U.S. tax and trade policies, North Korean instability in APAC, continuing uncertainties regarding Brexit and the upcoming German elections, there's plenty of changes ahead for deal makers to factor in formulating their growth strategies. Joining me to discuss the important topics today are, to my immediate left, Mark Vecchio, partner at the law firm of Venable, Gregory Bedrosian, managing partner and co-CEO, Drake Star Partners, and Parul Dubey, vice president at Yeni Capital. We'd like everyone watching to be part of today's conversation, so please submit your questions just to the right within your browser viewing window. Lots to cover today, so let's get started here. This is an open question for the panel, and Mark, I'd like to kind of start with you, but it's been an interesting year with the presidential elections, strong equity markets performance, a lot of tailwind provided for M&A. We've seen some interesting deals coming to light recently, like Amazon and Whole Foods, which we were just discussing earlier. Just wanted to kind of get your high-level thoughts in terms of how the market's been so far, and for the second half of the year, what impact or what you anticipate deal flow to be in the second half of 2017.
Sure, great, Brian. Well, thanks very much, first of all, for having us today. I think there's a lot of interesting things to talk about, and I'm looking forward to hearing my colleagues in terms of what's going on. I think in order to get the conversation started, it's important to realize where we are in terms of the deal flow. And interestingly, although it is true, we have heard of the likes of the Amazon deal, which get people very excited. The fact of the matter is the numbers are down significantly in 2017 relative both to 2016 and in fact over the past 5 years we're at really kind of an all-time low, which I think has a number of reasons that explains the level of inactivity. First and foremost, in my mind, it is uncertainty, right? I mean, investors, it's a well-known fact, investors don't like uncertainty. And we are in an environment now, both domestically and internationally, with a tremendous amount of uncertainty. Sure. So I think what that has resulted in is CEOs, boards, and others sort of taking their time, now looking very carefully at deals and not jumping into things. Mm-hmm. It's a little counterintuitive because the market is at an all-time high, and the Fed, and we'll talk a little bit about that in further discussions, but the Fed seems to be going along with a minimal approach to raising interest rates. But bottom line, right now we're kind of in a wait and see. My question is it the calm before the storm? And are we likely and hopefully maybe see increased deal flow towards the end of the year? Or are we looking at maybe a correction?
Sure. Greg, from your perspective?
Sure. Well, again, thank you for having me here and looking forward to the discussion. Just to pick up on some of Mark's comments, we see from the M&A perspective, day to day, it's really driven by several factors. Certainly board sentiment. Secondly, access to capital, a lot of that debt capital, but also equity capital. And third, the overall economic growth rates. And we touched on board sentiment, and certainly macro uncertainty does from time to time give pause in the boardroom. Access to capital, however, has been quite strong, both on the debt and the equity side. I think economic growth rates is one of the big question marks. Here in the U.S., we're seeing strong but possibly underperforming economic growth rates. In some of the other markets we'll talk about later, differing growth rates. But ironically, in a sense, if the growth rate is too strong, boards will try to have the businesses just grow organically. If there's a view that economic growth rates are going to top out at maybe 1.5%, 2%, for example, in the U.S., that might drive boards to try to meet their targets more inorganically through M&A.
And Parul, from the sponsor perspective.
Yeah, absolutely. And again, thanks for having us here. The market for M&A, just to pick up on the points made by Mark and Greg, it's important to see where we are coming from as well. And over the past couple of years, just piggybacking on your point, we saw a lot of strategics coming into the M&A market on the back of continued economic growth over the past 4 or 5 years. And as they have all this cash on the balance sheet to deploy, we have seen a surge in strategic corporate development sort of M&A activity. In addition to that, we have seen low interest rates, because of which a lot of private equity firms have been aggressive in looking for deals and closing deals. However, what that has done is that it has really driven up valuations and made the space extremely competitive. So I think that is another reason why we are probably seeing a slowdown this year, because the valuations are just high, and from a financial sponsor perspective, they don't justify financial returns. And where we do see activity is private equity firms that are looking to buy looking at add-on opportunities for existing portfolio companies to justify the existing premiums.
Sure. Great. So with that, I just want to touch on just a very broad political question, again, for the entire panel, and maybe we'll start with Parul this time. Political uncertainty across the globe. The U.S., everybody can define or what the uncertainty is. Europe, we have Brexit. That's largely been redefined with the parliamentary elections. German elections are coming up. Middle East, we all know what's going on there. The impact of deal making from a broad political sense, like what can really kind of stall or drive deal making in those regions globally?
Yeah, so I'll start with that. I completely agree that the enormous uncertainty in the world implies one thing, that a negative event anywhere in any part of the world, whether it's unrest in the Middle East, whether it's the uncertainty with Brexit negotiations, whether it's the future of EU on the whole, it can trigger a downturn even in the US over the intermediate term, and the anticipation of that can have its implications on deal making. Talking about Brexit, I lived in the UK for several years, and I worked for a very large financial institution in a client-facing role in a very traditional servicing sort of with that perspective. I was working with clients across all over Europe, and that's the case with most of the larger firms there. Now, I was just sharing that with Greg and Mark before the panel, that when I walked into the office in this account management team, I saw account managers on the phone with clients in Belgium, Netherlands, Luxembourg, across the board. And you heard different languages, different accents, different personalities. But even underlying that entire melting pot, there was this common feeling, unifying feeling of belonging to the EU, which I think is a very subtle point, but it has really impacted the ability of UK domiciled companies to do business across Europe. And I wonder what the impact is going to be now that the UK has decided to exit the EU, irrespective of the actual decision as to what the access is going to be to EU going forward. And while I think some of the larger institutions that already have very established reputation in what they do will be less impacted, I think some of the middle market companies, smaller businesses, will see adverse economic impact.
Greg?
Sure, yeah, I mean, just to pick up on some of those points, I mean, our firm, Drake Star Partners, has 9 offices across the US, Europe, and Asia, so we have a highly relevant vantage point for this question. And through my career as an investment banker, mostly focused on cross-border M&A, I kind of distill the cross-border M&A recipe into sort of 3 parts. It's one part finance and deal making, it's one part diplomacy, and it's one part social psychology. And all those pieces need to come together for a successful cross-border M&A deal to get done. Within the sectors that we focus on, which is predominantly tech, media, and communications, those industries tend to be more global by nature, and the leadership and the shareholder base tend to be. So certainly macroeconomic and political disruptions do have an impact, but those businesses that are highly focused on global expansion tend to continue through even uncertainty, or at least pause and continue soon thereafter rather than calling deals off. As an example, I mean, our firm in the last 6 months have closed in the tech and related sectors, a Chinese company acquiring a Spanish client of ours, an Indian investment into a Dutch tech company, a Japanese company acquiring a Swiss client of ours. So we're seeing that cross-border transaction activity when the board has conviction and when those 3 three kind of pieces of the puzzle on cross-border M&A fall into place.
Right. Mark, from a lawyer's perspective.
Yeah, no, it's interesting because somewhat counterintuitively, the fact of the matter is we're seeing a lot of activity in Europe and within Europe. Intra-European deals are actually at an all-time high. And I think it's interesting because the Brexit phenomenon, one would think, might have affected that. But by all accounts, it doesn't seem to have necessarily created that much of a headwind in terms of European deals. And I think that's partly to explain by virtue of the political situation that we see in Europe. There was a sort of a scare at the end of last year that we were going to be seeing a serious move to the right in terms of the Netherlands, Austria, France, all of which have had elections and all of which have proven to be much more moderate in terms of the outcomes. The Macron situation in France being the most recent and the most inspiring in the context of deal-making, central approach to moderation in terms of politics and renewed enthusiasm for maybe trying to reform the economy in a way that would prompt even more deal-making with France. In the UK, I was meeting just yesterday with friends, colleagues of ours from London, lawyers who are commenting the same thing, that the UK is a very strong economy, will continue to be strong, irrespective of what the deal ends up looking like with the EU. The anticipation is that there will be significant interest in the UK economy. And so while it is true, I don't want to contradict myself in terms of predictability being something that investors strive to achieve at all costs, the fact of the matter is we're seeing, in Europe, somewhat counterintuitively sort of good news relative to the lack of really good news here in the U.S.
And I think the progressive kind of movement out there is going to carry some of that wave. And it's interesting from a deal flow perspective, right after Brexit, to your point, intra-EMEA deals, minimal to no impact in terms of deal flow or early stage deal activity. One question that I forgot to tag onto that was China, obviously. There's been some tightening in Chinese government activity in terms of inbound deal flow and whatnot. Any perspective, and we'll start from you, Mark, in terms of what you foresee in China? Or
Interesting, yeah. So China has always been the great sleeping giant, the land of opportunity, in most cases unrealized, at least from the perspective of U.S. investors. The Chinese have tightened, as you know, in terms of the government approach to liquidity and the ability to actually finance international deals, and so there has been a little bit of a pullback on that score. And simultaneously, and I know you want to talk about this in a bit, Brian, but from the U.S. perspective, obviously, there's a wariness on behalf of the United States government in terms of what Chinese investment in the United States means, what is motivating Chinese investment, how much of it is government-owned, and how much of it is strategic and politically strategic as opposed to just commercial.
How transparent is that?
And how transparent is it, exactly right. And so that, to me, is really sort of the great unknown, and I think I don't anticipate a tremendous change in the foreseeable future in terms of deal flow from China for a whole bunch of reasons.
Okay. Any perspective from?
Yeah, I think from an investment banking perspective, from a sell-side M&A process, certainly when we're talking to clients, we'll say domestic U.S. clients, there was always invariably this view of, Greg, let's make sure there are an ample number of Chinese acquirers in the mix to reach out to, because they could be the group that pays the really high valuation. And so boards always wanted to see some of those players. As I mentioned, a moment ago, we completed a deal with a Chinese acquirer and a Spanish software client of ours. But certainly, especially here in the U.S., there's two factors. One is valuation, and have Chinese acquirers or investors become a little bit more savvy on valuation. But the second is ability to close. And so oftentimes, to generalize, there would be high indications of interest, but certainty of closure is not as high as perhaps the number 2 or the number 3 bid from a domestic U.S. or a European acquirer. And in an M&A process, our role, but also the board's role, is to get a deal closed, not to feel good about a high offer on paper that never gets done. And so I think the regulatory side, I know we're talking about the Chinese regulatory side and CFIUS later in the panel, and other elements on the Chinese side on capital controls throw certainty of closure into question, and I think that's having an impact.
Sure. On the sponsor side, are you guys coming up against Chinese strategics? And
Yeah, so we focus primarily at Yeni Capital on domestic deal flow, but there are a lot of Chinese private conglomerates that are continuing on the trend of globalization and looking for targets across the US and the EU, and we do come across Chinese strategics every now and then for opportunities. In my experience at an investment bank on the FIG team, I came across Chinese strategics looking at insurance opportunities, and that's something we read about in the news very regularly. So, and I think that will continue to take place even going forward.
Great. To get a bit more surgical with the next question, and Mark, as the lawyer here, we'll start with you.
I'm a lawyer, not a doctor.
And maybe based on his responses, Greg and Parul will have some comments on how this will impact them. But there's been a lot of kind of wet cement being laid or founded on U.S. domestic policies right now, from healthcare to trade, taxation. Not a lot of, for lack of a better word, successes in the administration yet. But based on where they're going and based on the general frameworks that have been given in policies by the Trump administration, how do you see that impacting domestic U.S. M&A over the next couple of months?
Yeah, no, I think that's the $62 million question. I think, look, from the perspective of the big picture, we've got three things that are really important. Taxation. Mm-hmm. And the noise is coming out of Washington, and the Trump campaign and the Republican platform has always been and continues to be very pro-business in terms of taxation. Now, that's great, and I think that explains a little bit of sort of the enthusiasm, and certainly what we saw out of the starting gate at the beginning of the year in terms of deal making, on the assumption that, yeah, we're going to be looking at a very, very different tax regime in the course of 2018. Well, maybe, right? And it looks, unfortunately, like we're not going to be seeing necessarily that dramatic a change in the tax code, at least for this year. Mm-hmm. What ends up happening is anyone's guess. Again, back to the sort of unpredictability issue. I think, generally speaking, to the extent that we can implement something of a pro-business tax reform in this country, that will spur the market. Whether or not we can pull it off, it remains to be seen because of the political environment, which everything costs money. And the question becomes, all right, if we reduce taxes, how are we going to deal with the deficit? And as well as I, Republicans aren't exactly all about deficit spending. So we have to sort of see where it comes out. That's issue number one. Issue number two, infrastructure. Another great platform of President Trump is invest in infrastructure, and everyone is in favor of that. All you need to do is take the subway, which we all did this morning coming down here, to know that we have tremendous needs in this country for investment in infrastructure. And there's a lot of money that's out there, at least private money, that's out there waiting for a structure in place to be able to utilize private funds in the infrastructure development space. But again, we haven't seen anything specific in terms of proposals coming from the administration, and query how that's going to play in Congress with respect to this whole question of who's paying for what and how do we finance it all. So it's possible that we might see some interesting developments out of Washington that make their way through Congress, both on taxation and on the infrastructure space. Healthcare is another sort of area that is relevant to all of us because we all live and die and we all have need for healthcare. How that gets spun and what happens to Obamacare, and whether there's there's not going to be a repeal of Obamacare by all accounts, a reform maybe, and if there is, and it becomes clear again how the rules of the game are going to play out, we might see some increased M&A activity in the healthcare space.
All right. Any comments to that, or?
Yeah, I think the tax reform, to that point, our stance is that even though there is a lot of conversation about that, and there may be eventually some sort of tax cuts, but we don't hold the view that there will be a very large-scale tax reform, and the overall economic impact of that on the GDP growth will be at most 20 to 30 basis points, but it won't be a very significant impact. So in terms of the impact on middle market deal making, we don't expect that to be a huge driver of M&A.
Sure.
Sure. I mean, just to pick up on the comments, we saw in our firm, because we're focused on tech, media, and communications companies, a lot of our clients are founder-owned. They're very sensitive to tax rates, and that drives actually in some cases an M&A decision. Right after the election results, with Trump elected president, we received a lot of inbound calls of owner founders thinking about this could be the year to sell the business. That was early on. Now that it's clear that whatever tax reform will happen will take longer, those discussions have now moved from more opportunistic, tax-related to more strategic. Is this the year, is next year the right year for me to explore selling a business? So we saw an immediate impact and then a real dissipation of the tax element driving transactions, and it's going back more to the fundamentals of does it make strategic sense?
Yeah, great. The next question we have is for Parul. The middle market's always been the strongest segment of the market in terms of M&A deal flow, and you're a middle market sponsor.
Yes, that's right.
Can you just give us a health check or a pulse check on the middle market and what you're seeing and what you anticipate for the remainder of the year?
Absolutely. So middle market has been strong. It has been stronger in recent years, and it's expected to continue to be strong going forward, primarily because of, there are a few reasons. One is that there's significant competition in the bulge mega deal space, and the valuations in the middle market continue to be attractive. So there is still possibility to generate the double-digit returns in late teens or 20s in the middle market through middle market investments. The second is that there is a surge of founder-owned businesses that have reached an inflection point where they're either undergoing succession or some sort of the founder is ready to scale, take the company to the next level, and they are in the market in search for capital, and that is driving up activity at the lower end of middle market, which is companies from $10 million in revenue to $100 million. Third thing, which is not a very strong factor maybe this year, but was in the last couple of years, were tightened lending conditions to those companies at that size. And again, these are companies that are less impacted by the broader macro trend, and they are more impacted by the specific fundamentals, the local factors, their own individual, management coming of age, and it's been interesting how the space is also starting to get competitive, so we may expect to see a correction there as well.
Any other perspectives on middle market activity?
While it is true that there's a lot of activity in the middle market, I still think at the end of the day, it's going to be a function of what's happening at the 30,000-foot level in terms of policies, because whether you're paying 10% tax or 30% tax, matters, and whether the deal is $5 billion or $50 million, it's still going to actually affect the outcome. So I think we're in the same situation with respect to the middle market as we are with respect to the larger market.
So I agree with that. I think the only thing to add there is that a lot of companies bear in mind in the lower middle market space, they tend to be established as pass-through entities. So from a seller standpoint, it doesn't really make a huge difference as to what the tax rates are. And also from a buyer's standpoint, because you will set up an LLC and you're not really taxing the operating income, you're distributing that. But I agree that the rate of that tax will impact the amount of operating income that you distribute to the owners. And then obviously taxation on carried interest, but that's a different topic. That will impact financial sponsors. And again, that's a big question mark.
That's going away.
Yeah.
Carried interest, I'm willing to bet that's gone. That's the one thing that there seems to be complete agreement on between the administration and Capitol Hill, and only our clients and you are really the ones who are sort of standing in the way of that happening. Yeah,
we'll try. We try our best.
Talking about financial policies, central bank tightening, federal fund rates steadily moving up. There's a lot of room for upward momentum there. Greg, some perspective and some foresight into how much more movement do you anticipate in the next couple of quarters?
Sure. Yeah, it's a great question, and it certainly directly impacts the the private equity and financial sponsor universe and M&A, but it has broader impacts. It's in a way a good news, bad news kind of question, because the market and we at our firm certainly anticipate gradual tightening. So the cost of debt is going to inch up. The good news is the Fed's doing that because there's confidence in the underlying economic growth, and ultimately, if especially in middle market M&A, from a financial sponsor's perspective, they would rather be investing in a business that's going to have more fundamental operating growth than worry about a marginal increase in the cost of debt. However, there will be an increase in the cost of debt, and in middle market lending, we can see that spigot turning off more quickly than in the multi-billion-dollar deal category where there's bigger cash flows at hand. And we've seen that before, where small increases in interest rates will start having some of the lenders, come forward with, deals that aren't very interesting for the financial sponsors, or not putting out term sheets altogether. Having said that, for the foreseeable future, we're involved in, as an example, two transactions right now on the sell side M&A process. We had 10 or 11 first round bids in both cases, both strategic and financial investors. One transaction closed recently. The last 3 bidders were financial sponsors, and a financial sponsor won. And we're now in exclusivity on the second transaction with a financial sponsor who outbid a strategic. So near term, but I'd welcome my panelists' view on that. But near term, we're still seeing the private equity universe be proactive and aggressive and fair on valuations.
Yeah, absolutely. I think there are two forces that are trying to counter each other. On one hand, you have high valuations, and on the other hand, you have the cost of debt is low, which facilitates more deal making from a financial sponsor standpoint. Now, there are good and bad to this. The good thing is that it is going to drive up activity even in the second half of the year. And even though central bank will increase rates, the rate at which they will increase is not expected to be very high, and also it's kind of uncertain as to what level are they going to increase to. Now, I think one of the negatives from this phenomenon is that it is really encouraging sponsors to take higher levels of leverage in their deals, and we are seeing 6 to 7 times multiples of EBITDA and higher than that in a lot of acquisitions. And as interest rates increase, it may be, and given the valuations are already high, it sort of raises the question mark as to how successful some of those investments will be. Just as a rule of thumb, we restrict our leverage to maximum 3 times EBITDA to avoid that risk. And even though the lending conditions are still favorable to private equity sponsors, we really look at the fundamentals of the business and back our investment thesis on actual potential for operational growth rather than financial engineering.
Right. And my next question was going to be directed at you also. It's kind of tied into that. How much dry powder is the market kind of sitting on right now?
Oh, there's plenty. There's as we talked about, there's strategics. There are private equity firms looking for their platforms, firms looking for their add-on opportunities, and it's what it's doing is that it's actually really forcing financial sponsors to come up with more and more creative deal sourcing strategies, because it's a seller's market, and there's rise of tech-enabled platforms for deal making. There is the whole concept of tapping into network niches. So if you're a sponsor that specializes in minority-owned businesses, you leverage that and try to find opportunities in that niche network. Or if you're a if you're investor in Hispanic-owned businesses, you do something else. And then the third is actually creating your own network niche by volunteering to go sit on the board of companies and mentoring them, running accelerator programs, and really building relationships with business owners earlier, way ahead of time, so that in the end, when the time comes to sell, they place more emphasis on the relationship that they already had with you versus the total cash.
Sure.
It's purely just cash. Cash will still be important, but we see a lot of sponsors coming up with all sorts of creative deal sourcing strategies.
Greg and Mark, any comments on how your sponsor clients are?
There's definitely a lot of dry powder,
Yeah.
for sure,
Yeah.
and that puts pressure, obviously, because PE firms want to deploy. You're not earning your carry on money sitting in the bank. So that is, it's a kind of a vicious circle or a virtuous circle, depending upon your perspective. But it does tend to drive up deal prices. I think, and we're seeing that across the board in TMT and in fintech, in infrastructure, and also the sort of the institutional investment world. Not only private equity, but also in investment funds, all sorts of 40 Act funds, hedge funds, and pension funds as well. There's a lot of money out there chasing relatively few deals, and that's creating a lot of competition in the marketplace.
Greg, or your clients?
Yeah, when we're seeing, in some cases we're on the buy side representing a private equity sponsor, looking at acquisition. We're more often on the sell side, on the M&A side, speaking to a bunch of different private equity sponsors. I mentioned my last example. There's often cases where there are multiple private equity sponsors in the right valuation range. And I do think, to pick up on the prior point, differentiation is really important. And there are a couple ways we're seeing. Part of it is that, whether it be sector focus or some other focus where the owner will be value add to the business, especially if the management team or part of the management team is remaining on. And the other is, approach to corporate governance, likability of the people that would be sitting on the board and being involved, basic things where they'll turn to us as the investment bank advisor and say, Greg, I kind of like the personality of this firm better than this, and I'd rather, if I'm going to be on the board with them and they're going to drive my business for the next 5 or 7 years, I'd rather have them. And so in some cases, while we think M&A and deal making is all high finance, a lot of it does come down to some of those personal elements that sway a deal one way or the other.
Yeah, and actually, just to emphasize on that point, we invested in a company last year, and it's a really interesting story because we pursued that opportunity via a tech platform a couple of years ago. And as you can imagine, the process became very competitive. There were several buyers on the table. We really liked this company. We did our due diligence, and we were one of maybe the last 5 buyers on the table. And then in the end, the seller went with another buyer, just mainly due to price considerations. And then they went through the process and the deal fell apart. And we maintain relationships with all intermediaries. We follow all deals that we pursue, even after we don't get them. And we were lucky that when the process fell apart, we were one of the first ones to receive the call for this deal. And that was a result of our having clicked very well with the owner. And also, since we had already done the due diligence, we were able to close this company in a shorter period of time. So yeah, I think I agree. There are probably 2 things that are important. One is having the discipline to sit out of a process, even if it's attractive, even if you're desperate, you have dry powder you have to deploy. And the second is to continue the relationship, both with the intermediary and also click with the owner. These 2 things can really help a financial sponsor at this point in time.
It's all about psychology. I completely agree with both Greg and Parul. It really is all about psychology.
Absolutely.
And that's my advice to anyone thinking about getting involved in business: is take a course in psychology at law school, or even better, at university.
You can't talk about M&A without activism, and I'd like to get the lawyer and the banker's perspective here as well. And Greg, it seems like you've been on both sides. Activism, how's it impacting the market, and when is activism good and when is activism bad?
Yeah, so great set of questions. So yeah, our firm, Drake Star Partners, we're involved often when an activist has approached a client of ours or a company to help them, think about dealing with it, but sometimes we're also brought in after, for example, an activist has perhaps prevailed to help implement a strategy, which could include divestitures or financings, et cetera. So a couple of themes from our experience, at least. Activism is here to stay. And importantly, it's an asset class. So pension funds and university endowments are investing in funds dedicated to this. So it's very different in terms of persona than the 1980s sort of swashbuckling activists that many of us kind of bring to memory when one mentions activists. It's an asset class, and there's a disciplined approach to thinking about which companies to get involved in. And so, is it good or is it bad? Certainly there are amongst the cadre of public companies a vast swath that are well managed and well structured from a board and governance perspective. There's another subset that candidly aren't. And from our perspective as investment banking intermediaries, the professional activist plays the role of kind of identifying those weak links, bringing them to bear, and seeing what happens. In fact, the Whole Foods transaction with Amazon was indirectly instigated from JANA Partners, an activist hedge fund, a while ago, taking a big stake and talking about changing the board and talking about other elements of what to do. Months and quarters passed, but it ultimately ended up with a transaction that was strategic and appears to be to the benefit of both the shareholders of Amazon and Whole Foods. Yeah.
I think the question you asked, is activism a good thing or a bad thing?
When is it a good thing?
Well, what I wanted to answer, I wanted to answer the question more easily with one single word, because there's an easy answer to, is activism a good or a bad thing? And the answer is yes.
Okay.
To completely echo Greg's point, I mean, there are certain circumstances, I think, where activism is absolutely necessary and a value creative mechanism. Sure. It's democracy at work, if you will, in the context of the market. And so there's a place for it. I think activists tend to get a bad rap for a whole bunch of reasons, many of which are valid, but I think most of which tend to be sort of emotional, back to the whole psychology and emotion discussion, without really understanding the role of the activist. And if an activist is doing something which is not in the best interest of a company from the perspective of the management, then the activist is then shooting themselves in the foot ultimately. And that's not the role of any investor, to shoot themselves in the foot, right? They have a different perception of what is the proper answer to a particular question, governance or what have you. But my view is let all voices be heard, and only good things come from discussion, from provocation. So I'm generally sort of neutral in terms of the whole activist discussion.
Great. Next question. I know we spoke about valuations throughout the course of the discussion, and this is for Parul and Greg. Just to kind of revisit that, are we trending towards these valuation gaps that maybe not as extreme as we saw in 2009, 2010, 2011? But where instances like we discussed, there's too much dry powder out there. There's too much cash chasing too few deals. Too many families coming in, never doing deals for the first time. Unexpected. Unrealistic anticipation for valuation and whatnot. Can you just kind of describe the market and what you're kind of seeing in terms of corporate expectations on the sell side?
Yeah, absolutely. So you're absolutely right. Funds like ours have historically had a lot of family offices, high net worth individuals as our limited partners, and we are seeing a lot of interest in them coming directly into the market, either via going direct, setting up their own investment arms, and hiring professionals from other private equity firms, or via just seeking co-investment opportunities with existing funds. And actually, it has become part of the offering of a lot of GPs to their LPs that if you invest with us, there will be fund economics, there will be co-investment opportunities, which is also a nice way for them to gain the know-how and experience of direct investing. To your point about valuations and where they're headed, my assessment is that there may be a further increase, even though they have been very high. There is an expectation that they may not be at their peak because of the new administration's plans that will promote further growth, and with all this additional types of players coming into the market to invest, it may increase competition across the board, not just mega deals, but also potentially middle market and lower middle market. And again, all that it suggests is that players with a true source of differentiation or ability to create value, being effective board members, they will be the ones who eventually get the deals, and also there might be some sort of consolidation, like larger firms slowly start absorbing some of the smaller players which can't be successful on their own. So that's the expectation there.
Greg, what are your clients seeing?
So, I mean, certainly there has been, and again, whether we're on the sell side trying to promote a strong valuation, whether on the buy side trying to compete against other buyers, we do both as their investment banking advisor. On the sell side, because of the preponderance of not only financial sponsors and strategics, and as we also talked about, family offices playing the role of private equity, there's no shortage of bidders for quality companies, and in a structured auction process, there's part of our role, but it's how it works, is to create a limited time frame to make a decision. And so that also exacerbates taking a view on certain diligence items, taking a view on certain ideas on how you're going to grow the business going forward just to win the deal. So that does promote valuation. The other thing that we've seen, again, it's particularly in the sectors that our firm is involved in, tech, media, communications, often the highest bidder or the group that's clearing the market isn't the most obvious one. It's sometimes a buyer from an adjacent sector. Mm-hmm. So we're seeing a lot of Industry 4.0, Internet of Things type transactions where an industrial company is actually the highest bidder for a business because it's more important for them as a platform to then do other things. Or on from a cross-border perspective, we're seeing a European acquirer or an Asian acquirer bidding a bit higher than a domestic player because they're looking for that business to be their platform in the US to then build and grow. And so sometimes the bidder that's driving the valuation is sort of the less obvious one, but there's good reason for them perhaps strategically paying a slightly higher price.
Sure. Speaking about cross-border activity and investments, CFIUS, how do you see that kind of changing over the next couple of quarters, or I guess more broadly with this administration? Any challenges that you've seen your clients face so far going through CFIUS review?
Sure, that's a great question. So the Committee on Foreign Investment of the United States, which is a interdepartmental organization sitting in Washington that combines the heads of all of our departments to look at foreign investment in the United States and the control of any business in the United States that involves critical infrastructure or has potential national security implications, right? That's my little lawyer's intro. The fact of the matter is, notwithstanding what I just spieled off, no one has any idea exactly what that means, right? Because there's no definition in the legislation. Everything is very subjective, and the deals that we have seen being bounced over the years from Washington have nothing really to do with the deals themselves, but are the result of things like an acquisition of a mine which happened to be too close to a military installation. So anyway, long story short, I think we are going to see some changes in the CFIUS area. And again, contrary to all of the noises that the Trump administration has been making so far in terms of regulation being a bad thing, and the hope and the expectation that we will see a less regulated environment in this country from a business perspective, that remains to be seen. He's certainly talking the talk, but whether that actually wends its way down into the bureaucracy, we'll see. But on the CFIUS side of the fence, I expect to see actually heightened, from the Trump administration, a heightened level of investigation and higher standards with respect to foreign investment in the United States, particularly from countries that are perceived as competitive with the United States, and that is first and foremost China. Mm-hmm. The big concern about Chinese investment in the United States, back to what we were talking about earlier, is who's standing behind this? What's the transparency? Is this actually the Chinese government trying to make a sort of geostrategic move as opposed to a purely commercial move? And to the extent that that's in fact the case, I think we'll see potential reluctance on behalf of the administration to allow that kind of thing to happen. Additionally, they've already spoken about, both the administration and Congress as well, introducing new levels of criteria that will be relevant to the CFIUS discussion. Today, reciprocity is not a relevant issue in terms of determining whether or not a particular investment will gain U.S. government approval. That may change, and if it does change, then again the China card becomes relevant because China is not nearly as reciprocal in terms of allowing U.S. investment into China, and so that will change the landscape. And one final point in terms of CFIUS, they're also talking about expanding the scope of industries to be covered to include agriculture, mm-hmm. which would be interesting and a change, and again, sort of meaning, contrary to everything else that Trump has been talking about, increased regulation and more difficult deal-making environment.
That does make sense. You don't want somebody coming in trying to make a bid for Monsanto from China or anything.
For example. The Germans already got that.
Yeah,
so
that's
a
right.
little late.
While we're kind of rounding out the discussion, Parul, you kind of mentioned adoption of technology in helping you become more competitive in the deal sourcing and phase or whatnot. Can you kind of elaborate and touch a little bit more on what type of technologies you've been using, what type of technology you've been seeing that have been helping make your life easier? And I want to kind of add a tail to that for Mark to kind of address any type of new and emerging technologies that lawyers have been using to help kind of deals. Help you expedite the deal process and diligence process?
Yeah, so we review about 200 deals, more than 200 deals a year, mm-hmm. and about a third of those are sourced through these tech-enabled platforms. We have Intralinks, of course. I use Axial as well, and it's interesting because what these platforms are doing is that they're mitigating a lot of informational asymmetry that historically permeated the lower middle market space. There was all this talk about unsophisticated sellers, boutique intermediaries who don't have access to a broad pool of buyers, and I think the technology, these online marketplaces for deals, they are changing that. It's almost like seeing the efficient market hypotheses in play, supported by this technology, like it would happen in any industry, and of course that has implications on valuations as well and increased competition. But overall, I think it's a good for the market because again, as sponsors focus more on identifying opportunities where they can add value rather than purely make decisions based on undervalued pricing considerations, we are going to see healthier companies at exit, and that is an overall positive for the market.
Yeah, so in the legal world, aside from the litigation context where AI is really important, but not necessarily of interest to us here on deal makers, in the M&A space, I think there are two areas in which AI is going to be increasingly important. One is due diligence, right? Because the ability to actually amass and to analyze huge amounts of data become really, really important. And if we can do that more quickly and more efficiently and more cheaply, then everyone is happy. So that's one area, I think. And the other area is just keeping up to date on market terms. Sure. And there too, the ability, via an algorithm or some sophisticated fintech technology to be able to sort of say, all right, here's the last 4,200 deals that have been done, and here's the average basket, and here's the average cap on liabilities, and here's the average survival period for reps and warranties. That kind of stuff to have at your fingertips is amazing and be a really valuable tool.
Yeah, we've been working with some very interesting AI-based platforms. It's extract and distill content out there, read the content with automation, and just put that in front of lawyers. We're still not automating lawyers out of the process at all. That's not not coming in the near future. But be able to make just get the salient content out to deal makers and decision makers much more quickly. It's a market that we've been keeping very good tabs on.
Actually, I'll add to that. I received a phone call from a firm yesterday, which specializes in machine learning-based resources for private equity firms to parse out all the deal flow that they receive, either in their inbox through direct investment bankers or through the various tech platforms that they have access to, and I think there is a real potential there, because there are several criteria, just purely financial criteria, which you can set up on these tech platforms. But then beyond that, just the underlying logic, the human logic that we use when we look at a certain industry, when we look at a certain size of the company, when we look at the situation that the founder is in, whether they want to roll equity or not, and it's a combination of these factors which a human looks at when they make a decision as to whether to pursue this deal or not. And I think that's something that machine learning that's a process machine learning can make more efficient going forward.
Great. Last question, and this is for the entire panel. Second half of 2017, the good, the bad, and the ugly on M&A. Just provide just your general assessments and thoughts for what we're going to look at for the remainder of the year. Start with you, Mark.
Well, unless we see a dramatic change in terms of the predictability of issues, I think we're going to be in for a quiet year, honestly.
Okay.
That's my bottom line.
Deal flow to remain relatively flat.
I think so.
Okay.
That could change if all of a sudden we see a dramatic change coming out of Washington in terms of some of the issues we've been discussing here today, but I don't see that happening.
Rick?
Yeah, we see a steady second half of the year. I think the outliers, perhaps on the upside, could be some of the big technology corporates with an enormous amount of cash, and like again the Amazon Whole Foods situation, looking to make some strategic acquisitions in sort of adjacent markets. Those could be some blockbuster headlines. Outside of that, we see more steady flow of M&A in the second half of the year.
You asked for the good, bad, and the ugly. So let me answer in that sequence. The good would be fewer deals, but higher quality deals. And when I say higher quality, I am talking about deals that lead to value creation in the long term. And the bad would be for firms, for financial sponsors who are looking to deploy capital. They facing more pressure on fees on committed capital by LPs, and navigating that conversation would be one of the challenges. And the ugly, as we covered before, would be encouragement in order to counter the higher valuations, the increase in leverage levels, which could lead to certain maybe situations when sponsors don't exercise the discipline that's necessary.
Right. We have a couple of questions coming in from the audience, and I think we have time to respond to about two of them. The first question is, what have you been seeing? What has the panel been seeing in terms of divestitures and sales of non-core assets?
GE.
Yes.
GE, ding. Ask Jeff Immelt about that.
Greg or Parul?
I guess given the size, especially from a middle market standpoint,
There's not a lot of non-core to
it's a little, it's a little bit of a tough question for the middle market.
our strategy is more focused on identifying companies that are really strong in their core
You wanna bolt on,
offering
not-
and
not-
just bolt on. And
yeah. Any comments, Greg?
Yeah, we haven't seen a particular swing one way or the other. There are certainly, especially with our offices in Europe, some more conglomerate structured businesses that do look to divest non-core assets from time to time. Also, we've seen in the family office arena, and that's both US and European family offices we work with, they're effectively a conglomerate in a sense because they have an indefinite holding period and often are buying businesses that are perhaps related tangentially but not directly, and but they're bringing them together. We're also seeing some pruning there as those family offices become a little bit more sophisticated and return focused. That's what we're seeing at least.
All right. Last question coming in, and the last one we can address is, what particular sectors do you expect to see strong activity? And I guess if you don't have activity, insight into strong activity, maybe weak activity, or sectors we should stay away from for the remainder of the year.
I can jump in. I think fintech is really interesting. It's an interesting industry. There's a lot going on in fintech, and I expect to see, relative to everything we're talking about, a fair amount of activity in fintech. Energy is continuing to be an interesting area.
Yeah.
Very volatile market. The international universe of energy making it all the more incumbent upon U.S. Domestic sources to solidify ability to produce energy in this country. So we'll sort of see. I think there's going to be renewed, no pun intended, renewed interest in the energy space. And then again, infrastructure, if and to the extent that we see some form of a project coming out of Washington that makes sense, that could be tremendously interesting.
Great. Greg?
Yeah, so to echo some of the comments that I made earlier, technology is an area that where we do see a lot of opportunity for transactions, both the big technology companies I mentioned earlier, either acquiring other tech companies or perhaps more brick and mortar type plays, as we talked about. But also the flip side is, again, the Industry 4.0, Internet of Things trend, some technology companies being targets for more traditional corporate. So within the technology sector, we're more optimistic than in many others in terms of activity for the rest of the year and early next year.
Great.
And we focus a lot on niche manufacturing and business services companies right now, and our sense is that companies that have exposure to end markets which are growing will be the ones that will be the most successful investments, and technology is a great example there. Sectors that we are looking to avoid, just being cautious on where we are, the economy and the outlook over the next 3 to 5 years. We are cautious on cyclical businesses. Having said that, there's still plenty of cyclical businesses out there which make for contrarian investment thesis, having navigated several rounds of recessions successfully, given their sticky customer base or whether it's a diversification of their clients. Those are the areas where we are focused on.
Great. Unfortunately, we are out of time today, but I want to thank you all for joining us. And a special thank you to our panelists, Parul Dubey of Yeni Capital, Gregory Bedrosian of Drake Star Partners, and Mark Vecchio of Venable. Thank you very much for your time, for attending today.
Thank you, Brian.
Thank you.
Thank you.